So the act was passed and signed late December. In the last several weeks, there's been lots of discussion, lots of things talked about. But basically, what we're going to get into today is looking at the individual items and the business items and kind of where they stand right now. We're still trying to figure out where and how some of these items will be placed into existence in the current tax or for 2018 and the future. But we do know that, like I said, there's been a major amount of tax reform, and we're going to have to live with this for about 8 more years unless they decide to make some of these items permanent. Right now, this is an 8-year bill for the most part because we do have to have some equalization of expenditures and tax revenues. So a lot of these items are for 8 years and then begin to sunset. So the rate changes. For the most part, we were hoping to get some major reductions here. We got some. If you look at the bottom end, really nothing, but as a top end, we dropped it from 39.6 to 37. Some of the tax simplification items, they were going to do away with some of these. We didn't do away with any of them. We just kind of reduced the upper end. These have become effective for 2018, and like I said, these will disappear January 1 of 2026. Also, the estates and trusts, you can kind of see those for whatever benefit that is. Most of us won't feel that one, but these are kind of where we're at the present time. Now, something that was major here. The current tax law changed the standard deduction. This for 2017, it's about $12,400. Starting this year, 2018, the married filing joint standard deduction goes from $12,000 to $24,000. Single went from $6,000 plus to $12,000. So what you end up with, if you're looking at this, how does this impact me? Basically, if you look at that 10% bracket, everybody's going to have more tax-free income by changing the standard deduction. Now, the personal exemptions, these are where everyone has this. If you're single, you have one. Married, you have yourself and your spouse. If you have children, you have one for each dependent. Well, for 2018 and through 2025, all personal exemptions have been suspended. This is part of that increase in the standard deduction. Is this good or bad? It's a hard one to answer. Doing the tax calculations, and if you've got children, family of 4, you're probably breaking even. 5 or more, you may be slipping backwards. Maybe. I'm going to talk a little bit more later about a credit and how it's changed, but for the most part, small families, winners, larger families, possibly losers. Don't really know all the impacts yet. Basically what it does, the exemption amount goes to 0 for those. So better off tax-wise. It depends. Like I said, family with 2, all things equal. Under the old rules, 2018 standard deduction, 13,000 plus 4 exemptions, so they can kind of get an idea. So you got 2 children, you got 29,600 tax-free income. Under the new rules, 24,000. You have to look at the child tax credit, and that number is and will go up for 2018 and beyond. It currently stands for 2017 at $1,000 per child. 2018 it goes to $2,000 per child. So if you look at that, and it's a true credit this time, or a larger credit. So if you look at what took place, the exemptions are before you figure the tax. The child tax credit comes after the tax is calculated. This is going to be on a case-by-case basis to determine who is better off and who is worse off, depending upon family size, the age of the dependents, what all the pieces of the puzzle are. Again, we won't know until we start filing 2018 returns to see truly how this impacts an individual. More individual changes. In the past, or currently and in the past, we've always had our rates, amounts, standard deduction, the brackets, all were and still are inflation adjusted. However, we used to use the standard consumer price index. Now they're changing it. They're using the consumer price index as outlined for urban individuals. It's considered a chained CPI. The reason what happens here is being it's chained means that consumers look at substituting goods depending upon relative prices. So what happens? Well, the index changes at a slower pace. It considers what consumers substitute. Consequently, it's a slower adjustment than the original CPI. Will it be that much slower? I don't know. But I do know that it is a slower and less effective adjustment. So that will have an impact on us. The kiddie tax. So if you've got children earning income, they have earned income plus then unearned income. Well, earned income is taxed at a single individual's rate, which is basically the way it always has been. They're taxed at their own tax rate. If they have unearned income, that's interest income from investments, that's capital gains. If they have some breeding investments again that increase in value and they sell them, the capital gains treatment. This does not apply to a child that has a 4-H project that's treated kind of as a business. That is earned income. So capital gains on sale of breeding animals in that scenario would still fall under the individual tax rates. The kiddie tax is taxed at the higher brackets. It was taxed at the parent's rate. Now they're changing to the estate and trust rate. So if you've got $12,500 of taxable income that comes from unearned sources, it's taxed at the 37% rate. So it changes how we treat children in terms of giving them assets that generate interest, generate dividends, generate capital gains that are not business related. Capital gains rates did not change. However, they're going to be indexed at the CPI-U indexing rate, so it's going to be a little slower adjustments. But if you look at what they are, if you're in the 10, 22% brackets, it's still taxed at 0. 15% if you're above that, up to 37% rates. 20% if you're in the 37% bracket. So for the most part, capital gains did not change that much. We still have part of them being taxed at a 0 rate. The worst case scenario is 20%. So if you consider all the income that you can generate, capital gain income is still a beneficial treatment compared to ordinary income. So if you can move money from or keep things in capital gains, you do come out much better off. For 2018, it shows you here the breakpoints of where we treat, move from one rate to another. 15% breakpoint starts at $77,200 of taxable income for married filing joint. You have to be above $479,000 to be impacted by the 20% break. So the 20% bracket, very high amounts of taxable income. The 15% bracket, up to $77,000. Another thing that has changed is income from pass-through entities. This is new, but basically, if you remember from the past, and some of our business folks or people running a business understand the domestic production activities deduction. Well, this is being replaced by a pass-through entities provision. And if you look at it, it begins again this year, 18. It's qualified business income. So an estate or trust that receives qualified business income, a partnership, an S Corp, a limited liability company that's not treated as a C Corp, sole proprietors, what they're allowed to do is generally deduct 25% of qualified business income. So if you're running a farm, or your wife has a business, or you have a business, or your spouse has a business, if it is generating income and it is a true qualified business income, that means it has to be earnings from that business. They are reduced by the amount of W-2 wages, but the rest of it, there is a cap, 20% tax rate. So if you're in the upper ends, you save because qualified business income is taxed at 20%, or 20% of it's not taxed, rather. You get a deduction. 20% of that business income is not taxed. So basically what happens here, we get a break. Just like the corporation got a break, they're essentially at a 21% bracket. If you look at where this is, if you're in the 35% bracket, essentially it drops back that business income to be taxed at 20%. Or doing the math. Not quite, but that's kind of a good way of looking at it. It does give everyone a break from the business side. Net operating losses. Now, this one's going to hurt a little bit. Net operating losses, what you've got is the rules changed. They're not allowed to be carried back except for farmers. They're carried forward. If you look at how it affects the farmers, excess farm losses, $300,000 if you have USDA subsidies, that no longer applies. The interalert is, like I said, not allowed to be carried back. It all carried forward to subsequent tax years. Is this good or bad? Well, what we used to see in the past, we had a net operating loss. We could carry it back 2 years on the most part, and we had the opportunity to get we did get a chance to get a tax refund. By eliminating that, no more tax refunds. We just offset future income. Personal and casualty theft losses do apply here. Personal casualty losses are allowed if they are in a federally declared disaster area. So if you had a casualty from a personal side due to fires, or fires in the Panhandle were not federally declared disasters, consequently those personal casualty losses, that would be the loss of items in the home, loss of items, loss of a personal car, things like that, those are suspended. So not good news there. Before I step forward here, one of the things that they did allow, though, was farmers to keep back the 5-year carryback or 2-year carryback, and we'll get more of that in the business item. So business side, carry back 2 years, forward 20 if it's farm. Otherwise, it's simply carried forward. Now, remember what I said a little while ago that the exemptions were going away, but the child tax credit, which is per child in your household under the age of 17, that credit was $1,000. Now it goes to $2,000. So if you look at where this thing applies, that credit is refundable up to $400 per child. In other words, if you have no tax liability, you can get a payment back from the IRS. That's where the refundable amount comes from, to the $1,400 per qualifying child. Qualifying child requires that we have a Social Security number for that child, and also that they are under the age of 17. If your adjusted income is high enough, however, that child tax credit will phase out. Non-child dependent was added under the new law. So if you have a dependent that you're taking care of that is not a child, that amount is now $500. So it does give us some breaks, some benefits of people that in our household. So if you've got parents that are living with you, they're considered a non-child dependent if you take care of more than 50% of their living expenses. So that amount is $500. They get that benefit. Itemized deductions. Oh, these are wonderful for us. Yes. They've done away with a bunch of them. Itemized deduction changes, again, 18. We're not going to be able to deduct our state, local, and foreign property taxes. State and local income taxes will be allowed up to a cap of $10,000 or married or filing separate, $5,000. So look at those. You can deduct state, local, foreign property taxes, state, local income taxes up to that cap. If you've got property tax on a farm property, business property, that is still deductible in full on the Schedule F, or if it's operating other type of business, it's deductible off of Schedule C. So if it's related to business, it's still tax deductible. Otherwise, it is not. Mortgage interest, it has changed drastically. We were under the rules where mortgage interest was deductible for your first and second home. Now it is only applied to your first home up to a indebtedness of $750,000. Married filing single, $375,000. Home equity mortgage interest, that deduction is suspended. Charitable contributions. The deduction limitation is increased. You've got to look at the contribution limit. It's now increased from 50 to 60% for most of these. Once we get to that level, most of us, our contributions to charitable organizations will not be subject to that, but you've kind of got to watch it. So the AGI limit, 100,000 limit, is now 60,000. So if your adjusted gross income is above that, then you've got some issues that you want to watch out for. If it's below that, you will not have any problems. We did have to have a contemporaneous written acknowledgement from a charity in the past that we've given a contribution to. In other words, if we gave money to a church, they had to give us a written acknowledgement of that. Those are repealed beginning 2017. So for 2017 and forward, we don't have to have that written acknowledgement. However, it is always beneficial to have that. Other suspended deductions, alimony deduction after 31 of 18, miscellaneous itemized deductions, there's a 2% floor, that's gone. Qualified bicycle commuting is gone. Moving expense reimbursement. So if you move, if you're reimbursed, that deduction is gone. Piece limitations. Many of you probably heard of this. It didn't really affect most of us in extension. Piece limitations, what they were, if you had income that was, or a significant amount of taxable income, once you reached those levels, your itemized deductions that you were allowed were reduced until possibly even some of them were phased out depending upon if your itemized or your adjusted gross income became large enough. Like I said, most of us in extension didn't have this problem. These were really high income earners. Well, these piece limitations and itemized deductions have been suspended. However, if you look at most of these itemized deductions, they have been suspended, so they really don't impact us anyway. Moving expense deduction is gone. I appreciate Congress not being able to take their living expenses as a deduction currently. Also, there was a repeal of the individual mandate for individuals to have insurance. The reason for this, there was a lot of individuals in the very low income brackets that we could not and will never get to buy insurance on any exchange. They're just not going to do it. The individual mandate said, well, if they didn't do it, there was going to be penalties. Those penalties they couldn't collect anyway. So really what they did here had no impact other than to relieve some of the record keeping requirements for IRS and others, because we did repeal that individual mandate, but it doesn't go in effect until December 31 of 2018. So for 2018, it's still there, but later years it goes away. The estate and gift tax, more from the gift tax point of view, that annual exclusion prior to January 1 of this year, it was $14,000. It has been indexed for inflation to $15,000. The estate tax exclusion went up. An individual now gets 11.2 from the period of January 1 of 2018 through December 31 of 2025. So we've doubled it. So basically what we have accomplished, it was 5.6 as of currently what was expected. With the passage of this, a husband and wife properly doing estate planning, estate transfers, getting everything done, can pass $22.4 million of property to their heirs tax-free if they pass after December 31 of 17 and before January 1 of 2026. So we did get some tax relief, only for a short amount of time. It will be interesting to see if we have the same impact that we saw from 2002 to 2010, where we saw the increase. It was supposed to sunset. Congress passed an extenders on that, and it became permanent. This may become permanent. We will have to wait and see. Right now, we do have the relief for these 8 years. Now, when we get into the tax reform on businesses, you can kind of see what's going on. The flat rate tax for corporations dropped from a max 21% from 35. So if you see a person or corporations that were low earning corporations in the 15% bracket, which we had some, basically they saw a 40% increase in their tax liability. So it was helpful to the large, very large corporations. It harmed some of our low-end corporations. Dividends received, well, that deduction percentage decreased to 65% from 80% on businesses. Corporate AMT, alternative minimum tax, has been repealed, so we did get some major reform and major tax relief there. So if you look at where some of the tax simplification came from, this is a big one. We did away with the corporate alternative minimum tax. That thing has been a burden to our corporations and large businesses. Further changes. Now this does affect our farmers. This will affect those of us that have outside businesses, those of you. The expensing and depreciation rules have been modified. The Section 179 has increased. It went up from a $500 million investment limit this past year, or investment amount within a $1 million investment limit. Future years goes up to $1 million with a $2.5 million. Now let me go and explain what expensing is. It's the ability that when you buy a new or used piece of equipment that it costs less than $1 million, we can write it off as depreciation in the year we buy it. So it effectively reduces our tax liability. It effectively reduces our self-employment tax. So we buy this large piece of equipment. We have a large amount of taxable income. It wipes all that taxable income out. It doesn't apply to sport utility vehicles. Those are still limited to $25,000. Full-size crew cab half-ton pickups with a short box that's less than 6.5 feet or less, they're considered SUVs by definition. So that amount is still $25,000 on those. If it's qualified real property, so if you're looking at a roof on a building, heating, ventilation, air conditioning replacements, fire protection, security alarm systems, those are all allowed to be expensed in the year they're put into service. So basically, there's no change other than the fact that we raised the investment limit to $2.5 million, and we increased the amount that can be expensed to $1 million. So what does that $2.5 million mean? Once we reach that $2.5 million investment, the next dollar reduces our amount that we can expense by $1. So if we buy $205,010,000 of investment, we're allowed $990,000 Section 179 deduction. Bonus depreciation was expected to sunset this coming year. It has been brought back and has been modified. Currently, for 2018, we've got, and that's until 2023, 100% bonus depreciation. So just like expensing, we can write off, under the new rules for both new and used property, 100% of that item in the year that is purchased. In 2023, it drops to 80. You can see it goes down to 20% in 2026. After that, bonus depreciation goes away. So for the next, basically 4 years, bonus depreciation, they're hoping to stimulate business, growth, investment in new property. So if this all works out, bonus depreciation, expensing, gives us a great opportunity to increase our business assets and reduce our tax liability. So if you look at it, new farming and business machinery depreciation, if it's placed into service after December 31st of 2017, cost recovery on new machinery and equipment is 5 years for machinery and equipment. Grain bins are 7. So what the new law did, we now have the ability to write that off under true 200% declining balance for 3, 7, and 10, 3, 5, 7, and 10-year property. Prior to this goes back to 1986. Farmers, by default, didn't have to keep records on pre-productive period items. So that's orchards, fruits and vegetables that required 2 years to start producing. They were required to use 150% declining balance. Well, for 8 years here, farmers, just like all the others, we get to use the faster write-off. If it's 15 and 20 year property, it still remains at 150%. We'll be sending out more information on how this thing works when we get some of the other issues resolved to really get a better handle on all the impacts. Now, business interest. This is going to sting. Farmers, other businesses, business interest, no matter what type it is, going to be subject to a disallowance of a deduction if net interest expense exceeds 30% of the business's adjustable taxable income. So if we look at a business that has $100,000 of taxable income, and their interest expense exceeds $30,000, they are going to be subject to a limitation or disallowance of that deduction of that excess. It's determined at the filer level. So if it's a sole proprietorship, partnership, subchapter S corporation, LLC that's not taxed as a C corp, they fall under these rules. It's got anything other than that, you look at the entity level. So tax filer level, but you've got to look at all the pieces of the puzzle here. This is going to have an impact on our businesses that are truly sole proprietors. Business interest, how's that work? Well, you're exempt from the rules if your average gross receipts from a 3-year period, so you look back at the last 3 periods, the last 3 tax years, if it doesn't exceed 25%, that limitation goes away. So when they said, oh, we're going to have tax simplification, this thing just complicated the issue really big. They can elect out of having to worry with this limitation if they use the alternate longer depreciation life. We have 2 sets of rules. General depreciation, GDS, alternate depreciation, ADS. What happens here is the ADS allows us a longer period of depreciation. So machinery and equipment, 5 is the short term, 7 is the longer term. If we elect to use the longer term, our business interest deduction does not apply. So when we look at all the items, farming businesses, this also applies to certain structures, single-purpose structures such as poultry houses, hog houses. The net operating loss, as I explained earlier when we talked about the individual side for casualty losses, the casualty carryback has been wiped out for the most part. Carry forward allowed until it's used up. 80% of taxable income is a limitation, so it can't reduce 100% of your taxable income. It only can reduce up to 80%. So there is a limitation of how much can be wiped out. But the carry forward that has been, we used to be with 20 years, now we don't have to worry about that. Carry forward until we use it up. For farmers, the 5-year carryback is wiped out, but farmers still are allowed to 2 years, so farmers, to give them some tax relief, net operating loss, carried back, get a refund for those prior 2 years and then carried forward indefinitely. Losses after this year, again, remember, 80%. There are some carryovers subject to that. So if you have additional carryovers, you've got to continue to watch this. It does max out at 80% per tax year. Domestic production activities deduction repealed. It's replaced by a new item, and it's a 20% deduction. We talked about that earlier. That's at 20% business deduction. So if you have income from a farm, other qualified business, you reduce the taxable income by 20% as a deduction. We don't pay tax on that. So the DPAD goes away, but we do get a 20% break deduction against business income that will basically helps all businesses, not just those that had the right to take the domestic activities deduction under the old rules. In other words, you had to have W-2 wages. Most of our farms didn't. So this new deduction does give us some benefits to farmers that they had not had in the past. Like-kind exchanges. Major change here. Under the old rules, we could like-kind exchange real property, so we could sell one farm, buy another farm, or basically exchange an old farm for a new farm. If we did everything correctly, we didn't have to pay any tax. It was a like-kind exchange. It'd be real estate, farmland, rental property. We could also change farmland for a apartment complex. So the old rules were very generous. We could exchange machinery and equipment for new machinery and equipment. Under the new rules, trades of equipment and machinery are no longer allowed for like-kind exchange. Only real estate, real property. That's buildings, that's land. Those still are ruled that it's pretty broad. Real property, any real property for other real property. So as long as it's used in business, then, or investment, it is allowed. If it's held for inventory, in other words, for resale, then it is not allowed for like-kind exchange purposes. So if you've got land, works, machinery, pickups, farmer used to be able to trade pickups. Basically what you did was you sold a new pickup or traded in a new pickup to the dealer, bought the new one. That was considered a like-kind exchange. You just rolled the depreciation into the new one. Now that will not happen. We're going to have a two-step process. Essentially, it is a sale, even though we traded in as a dealer. Considered the sale of the old and purchase of the new. The depreciation rules, bonus depreciation, Section 179, probably is going to offset the tax consequences for most states. However, if you're in a state that does not recognize the 179 and bonus depreciation, such as like Minnesota, North Carolina, this thing does not do anything but hurt. For Oklahoma, shouldn't be a problem. So where are we? Where are we going? We know more than got the bill passed. Some folks looked at it. The cooperatives is one group. Some of the other business groups saying there's a technical correction that needs to be made. They've already begun the process of introducing this. Right now, as of the last I saw, and that was Friday, the bill has not been introduced, but we do know that there will be some corrections, and what those are, I do not know all of them, but the 199A, that 20% business deduction, and for the co-ops and other businesses is being impacted. It's being looked at. That's going to be one of them. There's probably some other issues. I wouldn't be surprised if we look at the casualty losses. That may change as well. What happens here? Well, the Treasury Department is the one that looks at the new rules as passed by Congress. They write the rules and regulations. IRS is the ones that have to administer those. Well, with what was in the original bill, Tax Cuts and Jobs Act, once it was passed, there were some rules that basically were in conflict with the old law. The old law wasn't repealed, therefore we need the technical corrections. IRS, they're kind of in a standstill until we get what those new items will be. So we have new reality as of December 22nd. We may not know all the implications of the act and how the new rules, regulations will be applied, and probably until closer to mid-year. Hopefully not that long, but it sure wouldn't surprise me. So, thank you for listening to this. Have questions, email them to me. I will be sending out various items here in the very near future on what to expect. Doing a few tax update programs. There's a lot of items here that leave a lot of questions, and until we have a chance to digest these, I'm not sure we know exactly all the pieces. I received this morning 3 webinars links to talk about this from other states, and I'll be viewing those. And like I said, I'll be passing on this information to you as soon as it becomes available. But as of right now, this is what we know as it applies to our businesses, our individuals, and to the estates and trust items. So any questions? We're not seeing any at the present time. Our next scheduled session is for March. I'll give you an idea of what that is when we get closer. Right now, I think I've got one person, and they're still trying to kind of determine what it is they're looking at for a necessary item. I believe Kim Anderson will probably be giving us the crop update at that time. And so, if you have questions, like I said, email me. That's the safest way to catch me. As I learn more, I'll be posting it. If we get some more information, we may do another one of these webinars to give you a quick idea of what has changed. Other than that, thank you for attending. We will see you in March for sure.